what does full adoption look like? So I think one target is gold. Gold values are quite high at the moment because of the macro hedge phenomena where governments will buy gold in times of uncertainty. And so, but even there, with the current Bitcoin price level, it's within about a factor of 9 of reaching the gold market cap. But it seems logical that, if the institutional adoption continues and the retail interest continues, that Bitcoin could get there.
It's a great privilege to honor our next guest, Adam Back, an OG in the Bitcoin space. He's the co-founder of Blockstream, but equally importantly, he is cited in the original Satoshi Nakamoto white paper for Bitcoin. Adam's early work on Hashcash laid the foundations for the mining process we know today and the proof of work system that we know today. He's been dubbed or perhaps considered the real Satoshi.
I don't know about that, but it was a certainly interesting experience and ride getting kind of instant fame in Bitcoin relatively early on because of the Hashcash connection. And I was somebody that was interested in and implemented some of the previous more centralized electronic cash systems. So certainly, became very interested in Bitcoin as well.
What was your first but reaction to the email that you received from Satoshi?
Yeah, so I get a lot of emails every month or two from people using some of the open source code I've implemented or using some kind of applied paper, and Hashcash was one of those. And so, it felt like another one of those. I thought Satoshi Nakamoto is the real guy's name, developer or researcher. And I was involved in the attempts to build an electronic cash system after DigiCash, the previous system, had failed. And the reason it failed wasn't technological exactly, but it was because it was centralized. And this central database allowed you to verify that the coins were valid. And the company failed. So then the coins you might have became unspendable. And so, the people that were interested in electronic cash on the cypherpunks list, the way they reacted to that is to draw lessons that, electronic cash is very cool. We want to see it come back. We need to solve the decentralization problem. It's centralized, it failed, so we need a decentralized solution. That's very technically challenging.
Is it? So, but correct me if I'm wrong, but your original proof of work concept was not intended for money, right? It was for email filtering.
It was as a kind of postage stamp. Now, that was in the context of the DigiCash system, which had recently failed at that time. And so, the obvious thing for the anti-spam problem in a remailer context where you don't know who's sending it would be to use the electronic cash system. But given that the candidate then had failed and there was no clear technology solution to implement a decentralized one, I tried to solve a simpler problem, which became the postage stamp. But interestingly, within a day of posting that, multiple people independently observed its potential use to solve one of the problems of a decentralized system, which is how do you get money into it? So it brought in the concept immediately that, you could mine it. And so Hashcash became part of the design ideas like B-Money and BitGold in 1998, so a year later, and Halving's RPow in 2004, and then, of course, Bitcoin started in 2008 when Satoshi started emailing people.
I have one more question before I pass it over to Bonnie. Suppose we were to live on a desert island in a complete anarchy, where there's no centralized government, where there's no governing authority. It's just we do whatever we want. But we do need some sort of medium of exchange in order to operate this society, if you want to call it that. What kind of exchange system would you need for this particular type of society? Barter? Would it be coinage? You can't mint coinage because everybody has a different coin. How would that be standard unit of currency?
Yeah, I think what you've seen from human history is that money evolves as sort of a natural phenomena because people want to exchange. So they can exchange in terms of IOUs, like you provided me with some bread, I owe you for that. I'm producing something else, I provide it later, but that's inefficient. So what tends to happen is people settle on a standard good that's scarce, and that's evolved over time. Seashells, then gold, and now Bitcoin. I guess it's the new improved monetary technology. So I think people look for whatever is relatively scarce in the environment, the best candidate, and they end up using it for that purpose. So on this hypothetical island, that would be what, maybe it would be some hard to find seashells that you have to spend a lot of time looking for, or, some commodity like a gold ore or something like that. And so I think Bitcoin is really
digital seashell,
digital gold, a digital solution to that. So actually a better hard money.
If Satoshi would have chosen a slow decline instead of 4-year halving, how would that change the balance?
Yeah, I mean, it's an interesting question because some parts of Bitcoin look like they could have had alternative parameters and still probably worked. And so, you could certainly see a gradual, like a smooth slope of supply rather than one that's stepping every 4 years with half the supply and half the fresh supply. And so I think coincidentally, it seems that the halving cycle is a kind of heartbeat for the Bitcoin economy and market. It does seem to continue to affect the market cycle, even as it represents a smaller proportion of the coins in circulation. Now there are almost 20 million. And so the drop from, 6 1/4 to 3 1/8 is a smaller drop. So I think how that comes to still be economically significant is over time people learn to hold coins and not trade them. And so the coins that are left that can be reached in the market are shrinking as in line with the rate of supply is also shrinking. So they stay roughly in line, and that's how you can have this counterintuitive phenomena that something which is a smaller and smaller percentage versus supply still have a very noticeable effect on the market every halving. So I think it could have presumably worked without the halving, but the halving is a nice kind of economic cycle driver, it turns out.
It's just amazing how the design is so perfect. I remember you were talking about early days, people were worried about, the blockchain being too transparent. And now, Blockstream has this liquid that tries to protect privacy. Now tell me if the original Bitcoin design is for everyone to see the transaction, is that against the law of Bitcoin?
Well, I think, I was, because I was familiar with the previous systems, while they were centralized, the academic cryptographers had tried to arrive at the idealized or perfect characteristics for an electronic cash system. And of course, the technology wouldn't necessarily be quite able to meet that, but they were able to have extremely strong confidentiality and privacy of who was transacting with who. So it's really a bearer money with cryptographic assurance. And it turns out with a distributed system that cryptography doesn't work. And so, there are still ways to make it work, but they're far more complicated and less efficient. And so Bitcoin doesn't, out of the gate use those. And so, I would view the fact that Bitcoin doesn't bring those properties in its initial launch really a technological limitation and not, a design intention. But, that's speculation because Satoshi didn't explain. But I think, you can see that even in the Bitcoin paper, it's talking about, transacting without a middleman and bearer kind of cash-like properties, right? Which are actually better ensured by these cryptographic mechanisms. It's just that they are, they're harder and they're still not, probably quite at the stage you'd want to deploy them on Bitcoin, which has a lot of value on them.
So does that mean we'll see more and more chains that's being built that cares more about privacy?
Well, I think what tends to happen is that the features that, become available technologically get added to Bitcoin, either directly in the base layer or in layer twos, where there are trade-offs that don't quite make sense for the base layer. So, I think Bitcoin is, increasing market share. The new money coming in, via the ETFs are kind of the top 10% in terms of share portfolio minus the top 1%. So just, people with a portfolio that talk to their broker. So I think they're reallocating shares or gold ETFs into Bitcoin. all that money is going into Bitcoin, not into the other coins. And, the institutions have professional managers and they are focused on Bitcoin as well. So I think it's been, a market cycle that has seen Bitcoin rise while the rest of the assets have shrunk in market share, actually.
Bitcoin has changed the world, but what if it could do more than just sit in your wallet? Welcome to Core DAO, the largest Bitcoin DeFi ecosystem.
Today's sponsor, Core, has over 1 million weekly users, $500 million in total value locked, and more than 100 live projects. Core is the most advanced platform for putting your Bitcoin to work.
Core allows you to earn passive yield with no principal risk. In partnership with Maple Finance, Core is proud to introduce LST BTC, liquid staked Bitcoin.
For the first time, Bitcoin holders can earn sustainable passive yield without giving up custody or taking up excessive risk. LST BTC transforms Bitcoin into a productive asset. By time locking your BTC using proven on-chain mechanics, you unlock new staking rewards while maintaining full transparency and control. Stake Bitcoin and Core together to earn even more, thanks to a dynamic dual staking system that rewards deeper participation. This is more than DeFi. It's the bridge between Wall Street and Web3. LST BTC is designed to power the next generation of Bitcoin ETFs, structured financial products, and institutional grade strategies.
Bitcoin finally working for you. Not financial advice. Visit coredao.org to learn more. If you could go back to the day when you received the email from Satoshi, knowing what you know now, you can ask him 3 questions.
Well, I've been curious over time how he arrived at the solution, because people had been trying to find a way to make this work in 1997, 1998 already, right? And so there's a sort of technological leap between the proof of work and the scarcity, and how to have the system work without any identity, just that you work. So, we understand how Bitcoin works, but it's kind of a curiosity for me how he arrived at that idea, because a lot of people tried to find a solution and didn't. So that's one thing. I think there's some other curiosities, like why 21 million? Why not 42 or 10 million?
Oh, that's a good question.
Yeah, and no, I don't think there was really that much he could have done in terms of adding privacy technology into it. I did notice when first looking at Bitcoin that there was a potential solution in this 1999 paper called Auditable Electronic Cash that was actually compatible with a decentralized system. But the coins will be quite big, and it's kind of more esoteric, so maybe he didn't know about that solution. But yeah, I think it's been going very well since, and with the evolution of layer 2s and the continued gradual, careful evolution of layer 1 to sort of add flexibility to develop more types of layer 2s, things are going as well as anybody could expect. I think better even, right?
I'm surprised one of the questions isn't, who are you? That's the first thing I would have asked.
I wouldn't.
Well, at the time, I thought that was his name, right? So,
fair enough.
Yeah, of course, it is a curiosity as to who Satoshi might be. It's a kind of mystery that is, behind the currency. But
what's your favorite theory as to who it may be?
No, I don't know. It's like all of the ones that have been put forward seem to have some flaw where it's not quite believable. And so, of course, I know a number of people that were interested in this area, like developers and so on, but it seems like nobody seems to know who it is. And of course, there were people back in the mid-90s interested in privacy technology and electronic cash who are posting technical comments on a cypherpunks cryptography list using remailers. So already there were anonymous participants. So there's some kind of precedent for that kind of way to engage. But in any case, I think it's convenient and actually valuable for Bitcoin that we don't know who the founder is, because a lot of mainstream media tends to look for, the CEO or the leader and have the impression that if they could just persuade that person, that they could change the system to benefit their business or something like that. So now the fact that there's nobody to identify and that Bitcoin is, decentralized, chaotic, there's no individual, you can't talk to the miners, you can't talk to the developers, you can't talk to the companies. None of them can make a change. It's really a free market type of situation where the market decides how it evolves. So I think it's convenient that we don't know who Satoshi is actually.
Could it be a group of people? Because how can one person be that smart?
Yeah, I mean, that's one of the theories. I think the code probably is relatively uniform, and people tend to have different, there might be some kind of indications it was written by multiple people, different styles in different area or something. So my guess is it's one person, you know. And also, you know, if there's a lot of people, it's hard to keep a secret. You know, if one person can control information more carefully.
I'm already imagining our comment section would be Satoshi pretending to not know who is Satoshi.
It's just one person, but it's not me.
Okay.
We interviewed an investor yesterday who said that the probability of Bitcoin going to zero is now pretty much impossible. Well, what if we were to hypothetically break the proof of work consensus mechanism? How would that happen in theory?
Well, the proof of work mechanism is quite robust in the sense that it's using hash functions, and hash functions historically have suffered from mathematical degradations in their security properties. And then, so, you know, people used to use MD5. Then there were some problems discovered in it. You know, applications and internet protocols switched to SHA-1, and now we're using SHA-2. Now, it's interesting to see that SHA-1, even though it had some minor problems, would still be fine for Bitcoin mining. And the reason is that if there's a small advantage, say it becomes 2 times as easy to mine, the difficulty just doubles. And so you've got this kind of graceful degradation phenomena. And it seems like relatively unlikely based on what's happened with previous hash function failures between MD4, MD5, SHA-1. So the history of how they have, you know, slipped on their security properties is generally gradual. So I think that it's hard to envisage the proof of work part like fundamentally breaking. I think and you can always, you know, in a worst case, switch to a newer hash function or something. There are some newer ones now, SHA-3, for example. But I think the sort of mathematical risk is perhaps more on the digital signatures or the quantum risk, which people like to talk about. But I think even there are, you know, newer signature schemes which are secure even with quantum computers. And in my view, quantum computers are still a few decades away. They're quite early in their sort of fundamentals research. So I think, you know, you could make an analog between current CPUs and GPUs with, you know, tens of billions of transistors and very early experiments with digital circuits using, you know, cathode ray tubes, like a table with, you know, a number of transistor-like electronics, right? So it's really very, very early days because, you know, the quantum computers, the state of the art is to factorize the number 21, i.e. like what you would learn in primary school, that 3 times 7 is 21. That's the state of the art of what they can factorize. And even there, they had to cheat and not have any error correction. So the way that they sort of simulated that is they repeat the calculation 64,000 times and then see what the average, you know, the most probable answer is. Whereas in a real factorization, you know, you need to have the error correction as part of the system, not by repeating it, because it's already a lot of work without repetition.
We were talking to Mike Belshi at DAS, Digital Asset Summit, and he said, well, the biggest risk would be quantum computers attacking Satoshi's wallet because the big amount of Bitcoin.
Yeah, I mean, that is a transition question that, you know, if this happens within a couple of decades, the ecosystem will have to reach consensus on. But I think of the two outcomes that, you know, somebody with access to an expensive quantum computer at that point, in a couple of decades, if nothing changes, they might be able to take lost coins or Satoshi's coins if he doesn't move them, you know, if he's not still around. So, you know, in my mind, what would probably be the likely approach would be to introduce a quantum-ready signature mechanism, say in the next decade, and then people have a decade to move ahead of that. But some people have clearly just lost their keys, right? And we don't know if Satoshi is alive or not to move them, right? So I guess we'll find out, basically. And then, so I think probably the better direction would be to deprecate the deprecate the previous system. Now, so I think the likely direction would be to deprecate the ECDSA and Schnorr signatures so that you can't spend coins in that way. So that would mean after people had a decade to migrate to a quantum-ready signature setup, they wouldn't be able to spend. And so they would effectively be frozen. So, it's a delicate topic because people don't want their money to be frozen. But if the alternative is, economic chaos from somebody taking them, that's probably a less bad outcome.
We had a gentleman here for our first day as an interviewee. He's a big Bitcoiner, and he told us that one of the reasons that he became a Bitcoiner, or what convinced him to become a Bitcoiner, was in the early days when the Silk Road project was shut down. The government found the server and shut that down, but they could not shut down Bitcoin, even if they had attempted to. Can you just explain to the layman who may not be very technical why a centralized authority may have failed and why that's not really technically possible today?
Well, I think it's because Bitcoin is decentralized. So if you look at that DigiCash system that I mentioned in the mid-90s, there was one company operating it. So, the government or the authorities could go to them and say,
but you couldn't, in theory, find every node and shut that down.
Well, there's too many of them, and it's also reactive, right? So I think there are like 100,000 nodes, and you don't really know from looking at the network which ones are economically active. And you don't know who's running them. There's nodes on the internet. And so and people are running them for their own economic benefit, right, to validate the transactions they're doing. So, I think, changing the nodes won't work because, people will just start their own node. So it's sort of reactive, right? If you shut one down, 10 more appear or something. And if it's so widespread, 100,000 nodes, or it becomes 1 million nodes, it's, you're fighting against windmills or something, as the saying is, right? If you have a few companies, you can push them legally, establishment, governments, courts. But if you've got, 100 million users, 1 million nodes, and they feel that this is their, natural right to have hard money and, not be interfered with, you can't really stop them ultimately.
Can I just add another 200 million nodes? Then now I outnumber you.
Well, I think the thing is, and that arose in the sense that at some point in Bitcoin's history, people added nodes to try and indicate support for like a fork or something. But I think the thing that is the balance is that the nodes are only really economically significant if they have a user behind them that is transacting. So, what you're saying is correct, that in a distributed system where you don't have identity, you have the Sybil attack, which means that somebody could pretend to be 1,000 people or 1 million people. And, if you have a system that's designed badly, that could confuse or overwhelm the system. But in a Bitcoin model, what matters is actually the economic nodes or the economic weight of the nodes. So, if a particular node is a payment processor or an exchange, that one's carrying a lot of economic weight because they are verifying a lot of value daily. But if an individual's running a node, that's verifying the transactions that they do or their savings, that kind of thing. So it's a bit indirect, but I think those economic nodes are the more important ones than the sheer number. So most people are running it for a reason, which is, they have a wallet and they're using their own node or something like that.
But running a node has no financial incentive.
No, you don't get paid for it. It's a more of sort of self-protective incentive. So it's a bit like a say in gold. So you receive a gold payment, you want to check the gold is, authentic, it's pure gold. And so you will, use some assay method or, go to an expert to check the gold. In Bitcoin, the way you do that is you run a node and it tells you this is a real Bitcoin transaction. Where if you go through a service provider or third party, you're relying on them to do that. And so you don't really know for yourself, right? So a lot of people want to, have that bit of extra security for themselves, by running a node so they know they've assayed their own coins. So it's that kind of, the value is indirect. It's, verifying your coins. And, not everybody has to do that because there are, hundreds of thousands of other people doing it directly and, millions and millions of people doing it indirectly via different wallets and exchanges and things like that.
So Bitcoin halving affects the price perfectly. You can look at the chart. It looks perfect. Well, if everybody knows that, why don't people just buy early?
Yeah, that's a good question. And you can see it's a kind of arbitrage, right? So I think actually the reason is a bit sophisticated, which is that it's hard to arbitrage something which is volatile. So the thought experiment I was saying is, what if in a given country, the government reduces the taxation on rental properties? Mm-hmm. They cut it in half, to give people a month's notice. It's going to get cut in half. As soon as the news comes that, in a month or two, the tax is going to be half, the resale value of rental properties will jump immediately because house prices or apartments are relatively stable pricing. Now with Bitcoin, of course, everybody knows there's a halving coming at a date, actually a few years in advance, right? So let's say it's 6 months before the halving. Why don't people arbitrage that? And I think the reason is that, if they are not Bitcoin exposed, they're trying to do it on a dollar basis. They could see that it might have an impact on the price, but the timing is a bit uncertain. The price tends to move a bit after the halving. And, let's say they think they can make a 50% profit from this if they do it right. They might be worried that, they buy it, but the price is moving around at 40% volatility per year. So they might lose the 50%. And so they'd have that uncertainty, right? So I think that volatility makes it harder to arbitrage that event you can see is coming. Because normally markets try to price things in as soon as the information is known, and information is priced in. So I think it's a good question. And I think the volatility is something to do with why it doesn't get priced in. I think another reason can be that we know about a halving, but there's a lot of people who are looking at it from the outside who don't know a lot of the details, right? So it's obvious to us, but maybe it's not so obvious to the market. You would think, how could somebody hold Bitcoin and not know about the halving? But they probably do. And, they're looking at the financial news shows, which, are getting more sophisticated in their commentary these days. But going back a few years, they would sort of look at Bitcoin news and draw like the wrong market conclusion for it. And then, people who are kind of sitting on the outside look at their news and react to it and sort of create market opportunities for people who understood the market better.
Don't share this interview. Don't spoil our secrets. Keep markets inefficient for the people who do know.
That's your conclusion?
Yes. Well, I would like to move on to the future of finance that runs on Bitcoin, which is coincidentally the name of your panel that you did, or not panel, but the keynote speech that you did here at the Bitcoin Las Vegas conference. Tell us about the future of finance.
Well, I think it's an interesting time for the next wave of Bitcoin adoption, which is the early stages of the institutions, the easier access to the Bitcoin market via the ETFs. For a lot of people, the way they deal with their investments is they call their broker or financial advisors. So the ETFs give them a way to do that. You see the early stages of fund managers allocating Bitcoin into diversified funds. Most recently, BlackRock made a recommendation for a 2% allocation to a diversified portfolio. But I think the proportion of managed funds in Bitcoin is still extremely low. So I think that's yet to happen. They have a kind of careful, methodical process about how they would bring something to market. So it might take some months before they actually act on it and start to make it available to different segments of their investor clients. And then I think the other thing that's evolving is Bitcoin, the asset class, in terms of its technological handling, is starting to interface to traditional finance. So one way it does that is via custodians. So we're seeing more institutional level custodians come in. Blockstream made an investment in Blockstream Capital Partners made an investment in Kamenu, which is an institutional grade custodian for that reason. And the recent regulatory improvements in the US make it easier for the larger established custodians of shares and bonds to actually enter the Bitcoin custody market. So they're not in market yet, but the regulatory hurdle that made it difficult for them is now lifted. And so that might be another way that it makes it easier in the future for managed funds to participate in Bitcoin, because they'll be able to do it via a custodian that they already work with, let's say. And then the other part of it is using Bitcoin layer 2s like Liquid, which are sort of bringing the bearer, settlement, and simple smart contract advantages of the Bitcoin network, which is the most robust of the networks available, right? So I think it's sort of showing that Bitcoin can be an internet for money, but also an internet for assets. And so on Liquid, we have a number of different assets, about 3.3 billion. Now, one of the newer additions is securitized shares, which are interesting to Bitcoiners, so kind of crossover assets, so namely the treasury companies, so far MicroStrategy and Metaplanet, but more in the future. And what happens there is, there is a custodian that holds the underlying shares. The token you're buying is a security, so you have to enroll in order to buy it and receive it in a wallet. A recent phenomenon on Liquid is the introduction of crossover assets, so shares that are Bitcoin correlated in some way. And so the first two, obviously MicroStrategy being the first major treasury company in a public company format, and then also Metaplanet more recently. And the interesting thing, it's a security, so you have to enroll to be able to buy it and to transact it in a wallet. You can hold it in a wallet. It's a very Bitcoin-like experience on the Liquid network, with seeds, and you can sort of pay somebody, a hundredth of a MicroStrategy share to sell a lunch bill. It's around $4, let's say, $3.75, $4. And you can also trade in a 24/7 market, a sort of OTC non-custodial market. And this market is actually Bitcoin denominated. And on a weekend, it can achieve, it's achieved a similar volume to the Frankfurt ADR on MicroStrategy. But it's the only market that's open, and it's Bitcoin denominated, which is an interesting way to trade the treasury shares. It's in effect a kind of Bitcoin basis relative value trade, where you're looking at, the relative value between Bitcoin and a treasury company, so that you might buy it when the MNAV, like the market cap compared to the net asset value of the Bitcoin they hold, is low, and then sell it later when it's higher and buy back Bitcoin at a higher price, and where your objective is to increase slightly the amount of Bitcoin that you had before you went into the trade. So you can see that this market is a bit one-sided. There are clearly Bitcoin traders in there, but there's a bit of variation. And, even for traditional investors who are not looking at this trade on a Bitcoin basis, it's a 24/7 market. So it fills in some of the gaps where, you've got, particularly with the Japanese one from Europe, that that market starts at 2 a.m. That's quite difficult to interact with. And some of these markets have market halts. So the Japanese market is generally halting when the price moves more than 15% a day. And so you've seen a sort of difference in price between the US ADR for Metaplanet from the Japanese market. And so, a 24/7 market can help smooth that out and give more global access. I think sometimes people find it difficult to get access to shares on markets outside their jurisdiction.
I'm just wondering, what does your day look like? Because you know everything.
That's a lot of fun. Too many toys to play with, right? So I'm quite interested in trading and investment from the mid-90s. So Bitcoin presented, as well as a kind of technical interest in electronic cash. I'd say those previous electronic cash systems were more what we would call stable coins today. People were expecting to be able to, if they got deployed, to be able to wire money in, get some electronic money in euros or dollars or what have you, transact that in a bearer form online, and eventually be able to cash that in, back into a bank account. Where Bitcoin is more of a gold competitor. So it has an investment component, and of course the adoption story as it gains use is what's driving it. I think eventually it will reach full adoption. We don't know where that will be.
What does that look like?
What does full adoption look like? So I think the one target is gold, and gold values are quite high at the moment because of the macro hedge phenomena where governments will buy gold in times of uncertainty. And so, but even there, with the current Bitcoin price level, it's within about a factor of 9 of reaching the gold market cap. And then the larger addressable market for monetary premiums in different assets, like housing, there's a lot of monetary premium there where people will buy an apartment and not use it, not even rent it out, just as an investment vehicle, right? So you see a lot of underused housing premium in the housing sector in different countries, and obviously premium in shares in the stock markets and bonds and other forms of alternative assets. And so, how Finney actually estimated that to be 200 trillion, and surprisingly, he did this in I think 10th of January 2009, before there were any transactions and any market value. So it's quite a kind of forward-looking estimate, but it seems to be still, considered a reasonable estimate of the size of that addressable market. Now, we don't know, how much of that Bitcoin will capture. So there's a bit of conjecture there. But it seems logical that, if the institutional adoption continues and the retail interest continues, that Bitcoin could get there.
Let's talk about that prediction. So that was a long time ago, and I'm assuming people were shocked at that number back then.
Well, right. It was very fanciful because there were no users. I think he received the first transaction ever from Satoshi. And I think that was, I'm not sure if he got that transaction before he made that comment or after, but it may was even before any got that transaction. I believe he got it in block 9. So, probably he sent this comment after he received the transaction. So this is just what we learned afterwards, right? I wasn't paying attention during this time.
January 2009.
Yeah. So I mean, it was such a wild prediction that I think people would look at that as, a kind of imagination, hypothetical, right? Because I think the probability that the network would catch on, that users would use it, and a price would form, that there would be venues, exchange platforms you could trade it on. Those were all years away at that point. In fact, so there's a lot of uncertainty whether it would get there even.
I don't have a question that could top that. Let's end it here. That was a great end to the conversation. Thank you very much, Adam. Dr. Beck, pleasure meeting you.
Thanks for having me on.
Such a great chat.